Uh, I've read some of your work recently. You were part of a report on the future of finance, and what interested me was that you're not just looking at the aggregate growth of credit, you're actually looking at the channels
Yep.
of credit growth and how they relate to productivity growth versus other types of
Yep.
bubbles in consumption and so forth. Are you envisioning a regulatory philosophy where what you might say we rather than relying on the interest rate across sectors, that we might need some additional instruments to deal with credit allocation?
I think if you roll back 30 or 40 years to the reforms of the way that central banks and finance ministries worked in the 60s and 70s, there was a junking then of previous quantitative tools. So that in the UK we gave up on having significant reserve asset requirements, we gave up on quantitative limits on credit, and we ended up with a belief that first of all the public authorities should never have a point of view on the sectoral composition of credit, and secondly that the aggregate amount of credit was either not important, or if it was important could be totally governed by this wonderful magic lever, the interest rate, which would keep the whole thing in equilibrium. I think that was a mistake. I think if you go to the insights of Hyman Minsky and others, you understand that there is something about credit extended against assets that have replacement value, above all against real estate. I mean, against stock equities as well, but the most important is real estate. They can simply get locked into cycles where the very process of extending credit is generating an asset price increase, which is therefore appearing to validate the extension of credit, encourage the more extension of credit, but is also generating profit on bank balance sheets, which appears to be generating the extra capital which makes the credit extension possible. And I think we have to understand these cycles, and we have to understand the way that they are particularly important in both residential real estate but also commercial real estate. If you look at pretty much every banking crisis over the last 30 years, somewhere or other really bad commercial real estate lending is one of the crucial bits of it, and that is driven by these cycles. Now, we need to understand that that's what we're dealing with, and that may imply that optimal levers need to include quantitative controls of credit, which do distinguish between different sectors of the economy. Now, what is interesting is, what I've just said, if I'd said it 5 years ago, people would have thought I was just a complete heretic against the sort of religion of the time. Because first of all, I'd said monetary policy is not enough. I've implied that monetary stability doesn't ensure financial stability, and that was point one of the conventional wisdom. And secondly, I've suggested that we might even take a point of view that you have to slow down commercial real estate lending, but not necessarily lending to manufacturing companies or leisure companies or whatever. So that is right outside the previous conventional wisdom or the religion. But I think it is where you are taken if you actually start by asking an empirical analysis. If you say one of the things that economics ought to do is just get out the data and say, what are these categories of credit? What are they doing? What fundamental function do we think they are performing? And if I observe their dynamics over time, what is that telling me about how they are locked in self-reinforcing cycles? I think that empirical focus, inductive, looking at the facts and then inferring stuff from the facts, is incredibly important alongside what was the over-dominant side, which was the let me establish a set of nice pure axioms and then let me drive a mathematical model based on those axioms.